Welcome to the deep dive. Today we're jumping into something super important for, well, pretty much everyone thinking about the future. Retirement income and the taxes that come with it. Ever feel like you need a crystal ball for tax season, especially with pensions and annuities?
Oh, absolutely. It can seem really complicated.
Well, we don't have that crystal ball, but we are going to do a deep dive today. We want to clear things up.
Exactly. Our goal is clarity, practical steps. We'll walk through how pension and annuity income gets taxed, focusing on, how to fill out those forms step by step almost,
And crucially, we'll be highlighting those smart tax saving strategies along the way.
making sure you keep more of what you've earned.
Right. We want you to feel informed, feel empowered, really, when you're looking at your 2024 returns. And our main guide today, fresh info from IRS publication 575.
Hot off the presses, basically.
Let's do it. Let's simplify this. So first things first, pensions, annuities. What exactly does the IRS mean by these terms?
Good starting point. So fundamentally, they both mean a series of payments you get regularly. A pension, that's typically from an employer's plan after you retire.
Okay, based on work history, usually.
Yeah, often tied to years of service, salary, that sort of thing. An annuity is similar regular payments, but it comes from a contract. Maybe you bought it, maybe your employer did. It's paid out over more than a year.
Predictable payments, that's the core idea.
Predictable, ongoing payments. And they fall into two main types, which impacts the tax.
Oh, what are those?
Well, you've got periodic payments. Those are the regular annuity amounts paid at set intervals over years. Then there are non-periodic payments. Think lump sums or other one-off distributions. How their tax differs.
Gotcha.
Hmm.
And when these payments start, there's one form you absolutely need to watch for in the mail, right?
Definitely. That's Form 1099-R. It stands for distributions from pensions, annuities, retirement or profit-sharing plans, IRAs, insurance contracts, etc. Quite a mouthful.
Ah, yeah. What's the key thing to remember about that 1099-R?
Check it carefully. You'll get multiple copies, B, C, and 2. And critically, if you receive a corrected version, use that one. Always use the latest one.
Right, because an error on the original could mess up your whole tax calculation.
Precisely. You don't want that headache.
Okay, now for the really good stuff, our first tax-saving nugget. Recovering your own money, tax-free. How does that work?
Yeah, this is really significant for your bottom line. A good chunk of your pension or annuity payments might actually be tax-free
Oh, so?
because it's considered a return of your cost or your investment in the contract. Basically, it's the money you already put in using dollars that you already paid tax on.
Ah, so it's not new income, you're just getting your own investment back.
Exactly. Your cost includes things like premiums you paid or contributions made with after-tax money. What it doesn't include are amounts that were tax deferred, like pre-tax 401k contributions or money meant for health benefits.
Okay, that makes sense. So how do most people figure out that tax-free amount each month or year? Is there an easy way?
Yes, thankfully. For most qualified plans, we're talking typical employee pensions, qualified annuities, 403b plans. There's something called the simplified method.
Seems promising.
It is.
Yeah.
The idea is pretty straightforward.
Mm-hmm.
You take your total cost, that after-tax amount you invested, and divide it by the total number of monthly payments you're expected to receive based on IRS life expectancy tables.
And that gives you.
That gives you the fixed dollar amount that's tax-free each month.
Let's use the IRS example, Bill Smith.
Oh.
How does Bill figure this out?
Okay, Bill. He's 65, starts getting a joint and survivor annuity. That means it pays out as long as either he or his spouse is alive.
Right.
His cost, the after-tax money he put in, is $31,000. He gets $1,200 a month. Now, because it covers 2 lives, he looks at a specific IRS table, Table 2 in this case, using their combined ages.
Okay.
That table tells him the expected number of payments is 310 months. So he takes his $31,000 cost, divides it by 310 payments.
Which comes out to $100.
Exactly. $100 of his $1,200 monthly payment is tax-free every single month.
So out of $1,200, only $1,100 is taxable income for Bill each month. Nice. What happens if, say, Bill passes away first?
Good question. His spouse would then start receiving survivor benefits, let's say $600 a month in the example. She continues to exclude that same $100 per month.
Ah, okay. And this continues until the full cost is recovered.
Right. Once those 310 payments have been made, the full $31,000 cost has been recovered tax-free. After that point, any further payments are generally fully taxable.
But what if they both pass away before the 310 payments, before the full $31,000 is recovered?
That's an important point. If the full cost hasn't been recovered when the last annuitant dies, any unrecovered cost can be claimed as an itemized deduction on the final tax return.
Helpful for the estate, potentially. Now, you said simplified method is for most qualified plans. Is there another way?
There is. It's all the general rule, but honestly, it's mostly for non-qualified plans, and it's significantly more complex.
So probably need a tax pro for that one.
Usually, yes. You'd likely refer to a different IRS publication, Pub 939. But for most listeners, the simplified method is the one they'll encounter and use.
Good to know. Any other wrinkles with the cost recovery?
Just a quick historical note, if your annuity started way back, before 1987, the rules were a bit different. Your total tax-free amount wasn't capped at your cost.
Oh, interesting.
But for annuities starting after 1986, which is most of them now, your total tax-free exclusion is limited to your cost. Once you've recovered your cost, the rest is taxable.
Got it. Okay, let's shift gears. Tax-saving nugget number 2, rollovers. Why are these such a big deal?
Oh, rollovers are fundamental to smart retirement planning. We're talking about eligible rollover distributions from qualified plans.
And the benefit is?
Tax deferral. You move the money into another qualified plan or a traditional IRA, and you don't pay any tax on it until you actually take it out of the new plan. It keeps growing tax deferred.
Keeps the tax man away for longer.
Exactly. Sometimes for many, many years. But how you do the rollover is critical.
Ah, okay. You mentioned direct versus payment to you.
Yes, this is the key distinction. A direct rollover is, frankly, the gold standard. The money goes straight from Plan A to Plan B.
Untouched by human hands, so to speak.
Pretty much. And the huge advantage, no 20% federal income taxes withheld. The whole amount moves over.
Okay, so what's the other option? The payment to you.
That's where it gets tricky. If the plan pays the distribution directly to you, even if you intend to roll it over yourself, the payer must withhold 20% for federal taxes.
Whoa, wait. Even if I'm going to put it right into an IRA?
Yep, they have to withhold that 20%. You still have 60 days to complete the rollover into a new plan or IRA. But
They only received 80% of the money.
right. So to roll over the full original amount and avoid paying tax and potential penalties on the 20% that was withheld, you have to come up with that missing 20% from your own pocket.
Ouch. Let's use an example. Say a $10,000 distribution.
Okay? If it's paid to you, they withhold $2,000. You get a check for $8,000. To do a full rollover of the original $10,000 within 60 days, you need to deposit that $8,000 plus find another $2,000 somewhere else to add to it.
Otherwise, that $2,000 withheld is considered distributed, taxed, and potentially penalized.
That's correct. It creates a real cash flow issue and a tax headache if you're not prepared. So the message is clear.
Always choose the direct rollover if you can.
Absolutely. Tell your plan administrator, direct rollover, please. Now, there are some waivers for that 60-day rule, but they're for pretty specific situations like disasters or errors.
Okay. Are there other kinds of rollovers besides the standard pre-tax one?
Yes. Several important types. You can actually roll over non-taxable amounts too, things like your after-tax contribution.
Oh, where can those go?
They can go into another qualified plan that accepts them or into an IRA. If they go into an IRA, they become part of your basis, and you'll track that using Form 8606 so you don't pay tax on them again later.
Makes sense. What about non-cash distributions, like company stock?
Good point. If you receive property like stock, you have options. You can roll over the actual stock itself, or you can sell the stock and roll over the cash proceeds.
Any tax on the sale in that case?
Interestingly, no gain or loss is recognized on that sale if you roll over the entire proceeds within the 60-day window.
Handy. What about specific situations like divorce or inheritance?
Yes. If you receive funds as part of divorce settlement via a QDRO, a qualified domestic relations order, you, as the spouse or former spouse, generally get to use the rollover rules as if you were the original employee.
Okay, so you can roll it into your own IRA.
Exactly. And for beneficiaries, a surviving spouse has broad rollover options to their own IRA or even sometimes another qualified plan.
And non-spouse beneficiaries, like kids inheriting an IRA.
They have options too, though slightly more limited. A non-spouse beneficiary can typically do a direct trustee-to-trustee transfer to an inherited IRA. They can't just roll it into their own existing IRA, and the distribution rules for inherited IRAs are specific.
Important distinctions. Now let's talk Roth. This seems to be a really popular strategy. Roth rollovers or conversions.
Hugely popular, and for good reason. You could do an in-plan Roth rollover within your 401k, for example, or roll funds from a traditional IRA or 401k into a Roth IRA.
But there's a catch, right? You pay tax now.
That's the trade-off, yes. You have to pay income tax on the untaxed portion of the money you convert or roll over in the year you do it.
So why do it? What's the big payoff?
The payoff comes later. Once the money is in the Roth, assuming you meet the holding period and age requirements, all future qualified distributions, both your contributions and all the earnings, are completely tax-free.
Wow. Tax-free growth and tax-free withdrawals in retirement.
That's the lure. It's a bet that paying taxes now, perhaps at a known rate, is better than potentially paying higher taxes later on larger amounts.
A powerful long-term play. Okay, let's tackle something that causes a lot of worry. The 10% early distribution penalty. What's the basic rule?
The basic rule is, if you take money out of most qualified retirement plans or non-qualified annuities before you reach age 59 and a half, the taxable portion is generally hit with an extra 10% tax penalty on top of your regular income tax.
Ouch. That 10% can really bite. But you said generally. There are ways around it.
Yes, thankfully. There are quite a few exceptions to this penalty. Knowing them is key because life happens, and sometimes you need that money early.
So this isn't just about avoiding a penalty. It's about accessing your own money when needed. What are some key exceptions?
One major one is taking substantially equal periodic payments, often called SEPs or 72T payments.
How does that work?
You commit to taking a series of calculated regular payments based on your life expectancy or joint life expectancy with a beneficiary. If you stick to the plan, those withdrawals are penalty-free, even before 59 and a half.
Okay, a structured withdrawal plan. What else?
Big ones are distributions due to death payments to a beneficiary are never subject to the penalty or total and permanent disability.
Makes sense. Disability is a clear hardship.
And, new for 2024 returns, there's an exception if you're certified by a physician as having a terminal illness. That's a really important addition.
Definitely. What about leaving your job?
Yes, the separation from service exception. This is crucial. If you leave your job separate from service during or after the year you turning age 55,
Okay.
distributions from that specific employer's plan are penalty-free. There's an even earlier age, 50, for certain qualified public safety employees and private sector firefighters.
But the timing matters, right? Didn't the IRS example mention someone named George?
Right, the George example highlights this. He left his job at age 49. Even though he waited until he was 55 to take the money out, he didn't qualify for the exception because he separated from service before the year he turned 55.
So you have to leave the job in or after the year you hit 55. Or 50 for the safety officers. Got it. Any others?
Several more. Distributions up to the amount you can deduct as medical expenses, that's expenses exceeding 7.5% of your adjusted gross income, your AGI.
So if you have really high medical bills.
Exactly. Also, qualified reservist distributions, if you're called active duty. And for families, qualified birth or adoption distributions.
Oh, yeah, you mentioned that one earlier. How much is that?
Up to $5,000 per parent, per child, can be taken penalty-free within 1 year of the birth or adoption.
That could be a huge help for new parents.
Absolutely. And there are two more really significant new exceptions for 2024 returns we should highlight.
Okay.
First, distributions up to $10,000 for victims of domestic abuse, taken within a year of the abuse. Second, distributions for emergency personal expenses.
Emergency expenses, like what?
Unforeseeable or immediate financial needs relating to personal or family emergency expenses. There's a limit of $1,000 per year, penalty-free. And you generally can't take another one for 3 years unless you repay the first one.
Wow, okay. That's a lot of exceptions. So if one of these applies to you, how do you make sure the IRS knows so you don't get hit with the penalty?
Good question. Ideally, your Form 1099-IR in Box 7 will have a distribution code like 2 symbols for an early distribution exception, 3 cents for disability, or 4 for death.
So the payer might already know.
Sometimes. But if Box 7 shows code 1, which means early distribution, no known exception, but you do qualify for 1,
Then what?
then you need to file Form 5329, additional taxes on qualified plans. That's the form where you tell the IRS, hey, I qualify for exception number X, and you calculate that the penalty doesn't apply.
Okay, Form 5329 is key. If the 1099-IR doesn't already show the exception, don't just ignore it.
Definitely not. You have to claim the exception.
Now, speaking of fixing things or second chances, you mentioned repayments.
Yes, this is another fascinating point. Certain penalty-free early distributions can actually be repaid back into a plan or IRA.
Which ones?
Distributions like those for qualified disasters, the birth adoption ones, the new emergency personal expense and domestic abuse distributions, and the terminal illness ones. You generally have 3 years to repay them.
And what's the benefit of repaying?
It's treated as a tax-free rollover. It essentially undoes the tax consequences of the initial distribution. If you took out $5,000 for a birth, pay tax on it, and then repay it within 3 years.
You can get that tax back.
Exactly. If you repay in the same year you took the distribution, you just net it out on your return. If you repay in a later year, you actually file an amended return, Form 1040X, for the year you took the distribution,
Yeah.
reducing your income for that prior year.
That's powerful. A way to get a temporary loan from your retirement funds, essentially, for specific needs, and then make it whole again tax-wise.
A really useful provision for those specific circumstances.
Okay, a couple more specific items. What about retired public safety officers and insurance?
Right. There's a special rule for eligible retired public safety officers, police, firefighters, EMTs, etc. They can exclude up to $3,000 of distributions from their retirement plan from their income each year, if that money is used to directly pay for health or long-term care insurance premiums.
So $3,000 less taxable income just for paying their insurance.
Correct. They just need to make sure the premiums are paid directly from the plan to the insurer, or they handle it correctly. And on the tax form, you just write PSO next to the pension income line.
Good tip. End plan loans, are those always bad news tax-wise?
Not necessarily.
Mhm.
Taking a loan from your 401k or a similar plan can be treated as a taxable distribution, but there are big exceptions.
Like what?
If the loan is used to buy your main home, or if it's repaid within 5 years with regular level payments, then it's generally not treated as a distribution. It's a way to borrow from yourself without immediate tax consequences, as long as you follow the rules and pay it back on time.
Okay. And quickly, are there any special rules for people born a long time ago getting lump sums?
Yes, for participants born before January 2nd, 1936. If they receive a certain type of lump sum distribution, they might qualify for special calculation methods, capital gain treatment on a portion, or a 10-year tax option using Form 4972. It's complex, but can lower the tax bite significantly for those specific individuals.
Worth looking into if that applies. And railroad retirement,
Yeah.
different rules.
A little different. Part of it, the Social Security Equivalent Benefit, SSB, is taxed like Social Security. The other parts, like the non-Social Security Equivalent Benefit, NSSE and Tier 2, are taxed more like a typical pension, and you can recover your employee contributions tax-free from those parts using Form RRB DAISY 99R.
Okay, we've covered a ton of ground, lots of details and strategies. Let's bring it back to actually filing the return. What are the key forms again?
Right, the main one you receive is Form 1099 DAIS R, showing your distributions. You'll report the income from that on your main tax return, Form 1040, 1040 SR, or 1040 NR, typically on lines 5A and 5B.
Line 5A is the total distribution, 5B is the taxable amount.
Correct. Then, if you owe additional taxes like the 10% penalty, or if you're claiming an exception to that penalty, you'll likely need Form 5329.
Right, the penalty and exceptions form.
For those special lump sum calculations for folks born before 1936, that's Form 4972. And for disaster-related distributions and repayments, you might need Forms 8915D or 895F, depending on the disaster year.
Got it. And if people get stuck or need the official word?
IRS.gov. It's truly the best resource. All the forms, detailed instructions, publications like 575 have been discussing, it's all there.
Plus, ways to file electronically, maybe even for free.
Absolutely. Look into IRS Direct File or the Free File program partners. And don't forget, free help is available through VIR Volunteer Income Tax Assistance and TCE Tax Counseling for the elderly if you qualify based on income, age, or disability.
Excellent resources. And one last piece of advice.
Always check the What's New and Future Development sections in the IRS publications. Tax laws change. We saw new exceptions pop up just for 2024. Staying current is key to maximizing savings.
Fantastic advice. Wow. Okay, that really was a deep dive. We went through a covering your costs tax-free, the smart ways to use rollovers, dodging that 10% penalty, lots of actionable stuff.
Yeah, I think the main takeaway is that understanding these rules, your cost basis, the rollover options, those exceptions, it really can make a big difference to your bottom line in retirement. It's not just about compliance, it's about strategy.
Absolutely. So, for everyone listening, what's the one thing that really stood out to you today? Was it the power of that direct rollover? Or maybe an exception you didn't know existed?
Hopefully you're feeling a bit more confident now looking at that 1099-R, not as a puzzle, but as a map to keeping more of your money.
Exactly. So here's a final thought to leave you with. Now that you have these insights, how could planning strategically around your retirement distributions maybe help you reach a financial goal you thought was further off, maybe paying off the house early or funding that big trip?
Yeah. Proactive planning makes a difference.
Let that simmer. Thanks for joining us on the deep dive.